David Pezarkar, Chief Investment Officer Equities with BOI-AXA Investment Manager joins us. David, I guess it's pointless to talk about Nifty, Sensex, market range. For the moment, it's all about mid-caps and small caps and mid-caps and small caps.
Yes, Nikunj, that seems to be the flavor of the moment. Largely, I think, because of the absence of large institutional players. Although we have not seen any on-the-ground improvement, in terms of possibilities of higher revenues or an improvement in profits immediately in this quarter, but there certainly seems to be some investor interest in a large scale of mid-cap companies across sectors, and that could be partly driven by the fact that some of these companies were driven down to an extremely low valuations. But if one is looking for operational improvements to happen in this quarter itself, I feel that is unlikely. So in terms of earnings momentum, I think there could be some disappointment on that count, but definitely the sentiment for mid-cap seems to have improved. And I think that is also partly, due to the fact that there seems to be more retail participation in the markets, because other asset classes such as gold have been a large disappointment during 2013, as well as real estate. There also, it appears that the investment returns from that class might not be that appealing as of now. So there is more H&I interest in the markets, and which is possibly leading to this rise in mid-cap stocks.
David, hi, morning. What's the sense that you're getting, though? We've got two big events this month, that is the credit policy as well as earnings to deal with. What do you think is going to turn out to be more market moving at this juncture?
Well, I think the uncertainty as far as the credit policy is concerned is not there as of now. So I think we are likely to see rates continue to remain on hold as far as the credit policy is concerned, as inflation is expected to taper down. As far as the earnings are concerned, I think there is a lot of optimism already built into the market, so there is a possibility of some scope for disappointment. IT generally has a soft third quarter, so I think we will see revenue growth of around 2.5% to 3% thereabouts, and there could be some cross-currency headwinds there. Although the underlying improvement in the BFSI and other manufacturing-related sectors for the IT companies will continue to be there, but generally there will be a slightly slower quarter, largely because of the furloughs, etc. Also for the construction-related and capital goods-related companies, I think we will see a some sort of an escalation in their costs, and we are not seeing too much of an aggression as far as the order books are concerned. So I think it is going to be a slow quarter there as well. Banks also, I think private sector banks are likely to see some sort of a contraction in their NII growth, and possibly there could be some escalation as far as loan impairments for private sector banks are concerned. On the public sector bank side, I think loan impairments and fresh restructurings are likely to remain stable. But overall, if one looks at the broad market earnings momentum for this quarter, although we might see tepid earnings growth, unlike last quarter where there was where the market sentiment was poor and a slight improvement in terms of earnings had helped market sentiment. This particular quarter, it could be a slight reversal of fortunes. So I think there exists some possible scope of disappointment once the earnings season starts.
So do you expect, if you expect earnings to be muted, then why markets are moving up? And if markets have already moved up ahead of earnings, could we see a downside of about 10 to 15%?
Well, I would think that in the first half of 2014, we would see some sort of a downside in the markets, although it is difficult to say what could be the exact magnitude. First is that, equity markets across the world are highly correlated. So globally, markets have been going up, although emerging markets have not participated in that rally. But developed markets are hitting their all-time highs. And if one looks at the US particularly, the consensus trade for 2014 seems to be that equities will continue to outperform bonds. Even though I think if you look at the last quarter S&P 500 earnings, almost 100 companies have indicated for slower earnings growth than expected, and there were just about 10 or 12 companies which have indicated that their earnings are likely to surprise positively. On the other hand, the US 10-year yield has crossed 3%, and if one compares that yield with the inflation rate, then the real interest rates on US bonds is at around 1.7%, which is at around their average level. So bonds appear to offer value, but the consensus is that bond yields will continue to rise and equities will continue to outperform. Now, the cyclically adjusted price-earnings ratio of the US market is at 25, and history shows that at this level investors don't make money. So,
fair point. David, you're absolutely right. It's currently a Jekyll and Hyde kind of a situation for market. So you got good things and bad things. Good things are environment, stability in rupee, CAD problems. The bad things clearly are earnings have not bottomed out, and we don't know what will happen to elections. So David, the street is of the view that the real bull market for India will only start once the outcome of general election is clear. Are you with the consensus, or you think in the overall scheme of things, election at max could be a 5 or a 7% event?
Well, actually, I think when people talk of a real bull market, I think they are talking in terms of participation by companies across the market cap curve and across different sectors. So in that sense, yes, a change in government or a change in policy is likely to be the catalyst where we will see more of these companies participating, or maybe we will see an acceleration in the economic growth itself, or possibly we could see a control in terms of inflation, so we see lower interest rates. So all these things are possibly dependent on some sort of a change in policy or some sort of a change in government. So yes, if when we say that the real bull market, if by that we mean more participation by more a broader set of companies and more participation by domestic investors, then of course that is it is extremely likely that if there is a political change, that could happen. So I would think it is a very important watershed year for the Indian markets, and let's hope for the best.
David,
but at the same time, I think there are there are more and more uncertainties emerging, and the political equation seems to be changing a little bit to a more uncertain kind as of now.
Of late though, David, one has seen huge